Welcome to The Explainer. Today, we're diving into a story you think you know, but trust me, there's a twist you probably don't. It's all about the world's most famous investor, the legend, the recent struggles, and the absolutely stunning evolution that came next. So let's jump right in with a feeling that's been chasing Warren Buffett for almost 20 years now. This quote, it's from 2020, but really, it's nothing new. It's just the latest way of asking a question that's been swirling around for ages. Has the Oracle of Omaha finally lost his magic touch? But before we can really get into the challenge he faced, we have to talk about the legend itself. For more than 60 years, Buffett built this incredible empire, not with some complicated algorithm, but on a really clear, powerful, and simple philosophy. His entire success is built on just a few timeless, super straightforward principles that, honestly, anyone can get. It's all about patience, being rational, and looking at stocks not as these blinking numbers on a screen, but as what they really are, pieces of an actual business. Now, this quote, this is probably his most famous one. And it's not just some clever line. It is the absolute heart of his entire wealth-building strategy. Think about it. While most investors are sprinting for the exits during a crash, Buffett is the one reaching for his checkbook. And this right here, this is that strategy in action, perfectly. In the absolute depths of the 2008 financial crisis, when the whole world thought the banking system was about to collapse, he calmly invested $5 billion into a panicked Goldman Sachs. He brought calm when there was only fear, and for that, he walked away with over $3 billion in profit. Incredible. He explained this whole idea with his great analogy of Mr. Market. He said to imagine the stock market as this manic-depressive business partner. Some days, your partner is euphoric, offering to sell you his shares for ridiculously high prices. But on other days, he's in a total panic, and he'll offer to sell them to you for pennies on the dollar. The secret, Buffett says, is to just ignore his mood and use his foolishness for your own gain. You just focus on the real, long-term value of the company. For decades, this strategy was just unbeatable. But right when Buffett's legend seemed like it was carved in stone, the tide started to turn. The world was changing, and the very principles that made him a genius were about to face their biggest test yet. Remember the dot-com bubble? The criticism back then was deafening. Barron's even ran a cover story that said, "What's wrong, Warren?" basically calling him out for sitting out the big tech gold rush. But, well, Buffett got the last laugh, didn't he? When that bubble burst and wiped out billions, his boring, old-school, profitable businesses suddenly looked like pure genius. But here's the thing. That victory was surprisingly short-lived. After the dot-com crash, something totally changed. The data here is pretty stark. From 2003 on, Berkshire was suddenly 4 times more likely to underperform the market than in all the decades before. The king of investing was suddenly struggling just to keep up. And the reason why is this kind of strange twist of irony. He stayed away from technology because it was outside his circle of competence, the very rule that made him so successful in the first place. He even joked that his good friend Bill Gates would have better luck explaining tech to chimps. So this discipline, which was once his greatest strength, was now becoming a major blind spot. And here's what the tech visionary Mark Andreessen figured out. The ideas behind the dot-com bubble, things like online shopping and services, they weren't wrong. They were just early. So Buffett's victory over the bust, that wasn't the end of the story. Nope, it was just a delay. The digital economy was coming, whether he was ready or not. To really get why the world changed, we have to look at this fundamental shift in what actually makes a business valuable. The very definition of an asset was being rewritten right under our feet. Okay, this chart right here, this is the aha moment. Right around the year 2000, for the first time ever, private investment in intangible assets. We're talking things like software, intellectual property, brand recognition. It actually surpassed investment in tangible assets, like factories and machines. The economy just quietly transformed from being about physical stuff to being about ideas. And this one shift, it explains everything. Buffett's whole value investing model was perfected for that old economy of railroads and steel mills, where you could literally count the factories to figure out what a company was worth. But the new giants of tech, they were asset light. Their real value wasn't on the balance sheet, it was hidden in their code, their patents, and their massive user networks. But this isn't a story of decline. Far from it. This is a story of evolution. Because when faced with a new world that didn't fit his old maps, Buffett did something that very few people at his level of success ever do. He started to learn. So let's go back to that core principle, the circle of competence. For decades, Buffett's circle was famously intentionally small. It had insurance companies, banks, consumer goods like Coca-Cola. And it specifically excluded tech, which he was always the first to admit he just didn't get. This timeline shows such a fascinating journey. So after famously passing on companies like Google, he finally makes his first big tech move in 2011 with IBM. It didn't go so well. He later admitted it was probably a mistake. But here's the key. Instead of giving up, he learned from it. And then, in 2017, he started buying Apple stock. And he didn't just buy a little. Between 2016 and 2018, Berkshire Hathaway plowed a staggering $35 billion into Apple. It was a massive, concentrated bet that seemed to fly in the face of everything he had preached for 50 years. And that one investment, it has since made Berkshire a profit of over $65 billion. It's truly one of the greatest trades of all time. The old master had learned a pretty spectacular new trick. So how did he pull off this huge shift? Well, the genius move here wasn't throwing out his old principles. It was expanding his circle of competence. He finally saw Apple not as some complicated tech company, but as a consumer products company with an incredibly powerful brand and what he called a permanent ecosystem. He just found a new kind of business moat that he could finally understand. But Buffett's evolution wasn't just about what companies he bought. The real, ultimate test was about how he operated. A test that would force him to prove his deepest principles weren't just for show, especially when things got really tough. In 2011, a crisis hit home. David Sokol, Buffett's protege and the guy everyone thought would be his successor, got caught up in an insider trading scandal. See, he'd bought shares in a company called Lubrizol right before he recommended that Berkshire buy the whole company. When it all came out, Buffett didn't cover for his friend. He went public and called Sokol's actions inexplicable and inexcusable. He chose absolute integrity over personal loyalty. And that moment, that's such a powerful reminder of what his success is really built on. It proves his core principles are about way more than just making money. They're about building a culture of trust that lasts for decades. It's not just about what you buy, it's about how you operate. So as you think about your own approach in investing or just in life, the question this whole story really leaves us with is this. Your circle of competence, what you're an expert in, it's absolutely vital for success. But in a world that is always, always changing, you have to ask yourself, are the borders of that circle a fortress that's protecting you, or are they a cage that's holding you back?